Good morning and welcome to this conference. And it's good to see so many familiar faces here and good to see some not so familiar faces, new people. Hearty welcome to all those who come here for the first time. So friends, as you can see, the title of the conference theme this time is Time to Take an Active Look. So why do we say that? Let me now set the stage for that. Okay, so my presentation is titled Time to Take an Active Look at Passives. So this presentation is going to be in two parts. First, we will look at why passives make sense for investors. And secondly, we will look at why do passives make business sense for you? How do passives add value to your business? So should I get started?
Yes, sir. Yes.
Okay, so as I said, first let us look at why do passives make an interesting proposition for investors. Number one, the foremost reason why passives make sense for investors is they're very, very cost efficient. As we all know, passives charge much less expenses than active funds. This results in a savings of a few basis points. And over the years, with the power of compounding, this leads to substantial cost savings. जैसे हम लोग बोलते हैं हिंदी में बूंद बूंद से सागर बनता है. So this leads to substantial cost savings for the client. Number two is that there is no drama as far as performance is concerned. You are neither likely to make outsized returns, nor are you going to lose money when compared to the benchmark. So, in fact, I was just looking at some study yesterday in the office, and I was looking at the performance of ELSS category for 5 years. And I found that the best ELSS had given 7% over the benchmark index. However, the worst of them had lost 13% against the index. So there was a variance of 20%. I looked at many other fund categories also, and 5 years is a fairly substantial time. And I found that the variance was typically in the range of +5 to -5. So if you bet on the wrong horse, then you could end up losing money. So this doesn't take place in passive funds. And investors love the stability and predictability of returns, which is associated with passive funds. The third virtue of passive funds is transparency. We know that passive funds are always benchmarked against an index. We know the composition of the index. We know what sector will it be investing in. We know what market cap. We know what stocks will make up the index. So there is complete transparency in the running of an index fund. And this is something which investors value a lot.
Okay.
And finally, low maintenance and simplicity. As we know that with active funds, we have to be constantly on the toes. We need to keep monitoring it. We need to know whether our fund is performing well or not. How is it performing against the benchmark? How is it performing against the peers? However, with index funds, we don't need to do that. Also, index funds, the concept is relatively much simpler, and hence we are able to explain to our clients very clearly about how the fund is run. Now let's look at why do passive funds make sense for you? How do they add value to your business? First, I want to say that this is something, a concept whose time has come. Okay, world over, as Anita was saying, passives have caught on in a very, very big way. Today, investors love transparency. They love to invest in low cost. At least a substantial part of the market does. Okay. And finally, I want to make one point. Supply creates its own demand. You know, there are so many new categories of investments which were introduced to the country through ETFs and index funds. Recall, Motilal Oswal had launched the first NASDAQ fund. Now that is a fund through which Indians had access to NASDAQ stocks. Now, this was something which would not have been possible otherwise. Why? Because we do not have that kind of expertise available in the country. If we were to hire talent to manage such things in India, it would cost us a lot. In fact, last year, Bandhan Mutual Fund had launched an international US debt fund. Again, this is a this is a category which is completely new to the country. So what the point I'm trying to make is it gives us access to categories which active funds don't. And this creates its own demand. So the next point I want to make is that client acquisition and retention is made easier through passive funds. Since there is no risk of underperformance, the clients are likely to stick to you. You do not need to make explanations of any kind regarding underperformance and so on. Your task is made much easier. Hence, clients are likely to stick around much longer. And then, one very important thing is that through passive funds, you de-risk and diversify your business. I had carried out a research about 5 years back, and I found that 90% of the MFDs had 90% active funds in their portfolio. Okay. Now that means your business is too dependent on a single category of funds. That's putting your business to risk. We've been, of course, fortunate in India to have had a very good run for the last decade or so. However, this is a cyclical business. Things are not always going to be this hunky-dory, and there will be times when the markets will correct. There will be times when your clients will run out of patience with underperformance of funds. No more can you take it for granted that your funds will outperform. It's very, very difficult to predict. Even if a lot of funds do outperform, it's very, very difficult to pick the right horse in advance. So that is one risk that you run. So the point I'm trying to make is that don't put all your eggs in the same basket. Have a good mix of both active funds and passive funds in your portfolio. And like mentioned earlier, this is a concept whose time has come. This is not a transient fad. This is not a flavor of the day. This is something which has come to stay. And as Anita had mentioned, she gives statistics of US market, UK market, and this has been the case. In fact, in India right now, passives account for 17% of the market. Last evening, some data had come in. The AUM of the passives industry stands at 9.5 lakh crore.
Wow.
Okay. And the total industry size is 54 lakh crore. This is the data which came in last evening. So this means that passives constitute 17% of the the number of investors. Can anyone hazard a guess how many investors are there in the passives category, all put together? ETFs, gold ETFs, index funds, FOFs. How many investors do you think there are? Can anyone hazard a guess? Deepak, would you like to hazard a guess?
2 crore.
2 crore? Okay. Only in this category. So I'm talking about the number of folios. So the number of folios, there are 2.79 crores of investors, 2.8 crores in the passives category, which means it forms a substantial part of the market, and you are depriving yourself of a great opportunity if you stay out of it. Okay? And with passives, the last 2 points, you increase your wallet share. Your client is going to look at a mix of both active funds and passive funds. So if you're not going to be there, you're going to be missing out on this particular chunk of this thing. Finally, there are going to be higher profits if you include passive funds in your this thing. They may not come at the same margin as the active equity funds, but if you look at the total size of your business grows, and this increase in business will give you incremental revenues. Okay, may not be at the same margin as active funds, but then I think it is a product which is terrific for the investors, and I think it is a terrific product for your business. I would like to end with a share. वक्त संग बदल गया वो सवर गया वक्त संग बदल गया वो सवर गया जो सोचता रह गया वो बिखर गया okay so friends thank you all for being here. Thank you for being so patient with my presentation. And today we have 25 speakers who are going to be here sharing their knowledge and insight with you. So make the most of it, and I wish you all the best.
Okay.